Something extraordinary is happening in the silver market right now, and most people have no idea what's coming. While everyone's been watching gold hit record after record, silver has been quietly setting up for what could be the most explosive move in precious metals history. And I'm not talking about a modest rally. I'm talking about a moonshot that could redefine wealth preservation for an entire generation. Let me show you what the big institutions are seeing that retail investors are completely missing. Because what's unfolding right now isn't just another bull market cycle. This is a structural shift that's been building for years, and we're approaching the breaking point where the mathematics of supply and demand become absolutely undeniable. Here's what nobody's talking about. Silver just experienced something that hasn't happened in over 4 decades. The market is now in its 5th consecutive year of supply deficits. Think about that for a moment. 5 straight years where global demand has exceeded what mines can pull out of the ground. And unlike previous deficit cycles that eventually corrected themselves, this one is accelerating. The deficit isn't shrinking, it's expanding. The Silver Institute just released data showing that industrial demand alone is consuming silver at a pace that would have seemed impossible just a few years ago. We're talking about over 1 billion ounces of annual demand, with industrial applications accounting for more than half of that. Solar panels, electric vehicles, 5G infrastructure, medical devices, water purification systems. Every major technological advancement of the next decade requires silver. Not wants it, requires it. There is no substitute that matches silver's unique combination of electrical conductivity, thermal conductivity, and reflectivity. And here's where it gets really interesting. While industrial demand is soaring, mine production has essentially flatlined. The easy silver has already been extracted. What's left requires deeper drilling, more complex extraction processes, and significantly higher costs. Mining companies aren't rushing to open new silver mines because the economics don't work at current price levels. They need higher prices to justify the capital expenditure, but that creates a catch-22. Without higher prices, no new supply. Without new supply, prices must rise. It's a feedback loop that's about to go parabolic. Now, before we go deeper into what this means for your wealth, I want to mention something quickly. I've put together a free guide that breaks down the saving secrets thousands of American retirees are using right now to protect their hard-earned wealth from what's coming. It's in the description below. No cost, no obligation, just information that could make a significant difference in how you navigate the next few years. Grab it while it's still available. Let me paint you a picture of what's happening behind the scenes at the COMEX, the world's largest silver futures exchange. This is where the paper silver market operates, where contracts representing millions of ounces change hands every single day. And right now, something unprecedented is occurring. The ratio of paper silver to physical silver has reached levels that would make any risk manager break out in a cold sweat. Here's how this works. When you buy a silver futures contract, you're essentially buying a promise that you can take delivery of physical silver at a future date. Most traders never actually take delivery. They just trade the contracts back and forth, speculating on price movements. But what happens when a significant number of contract holders decide they want the actual metal? That's when you discover how much real silver actually backs all those paper promises. Recent data from the COMEX shows that the amount of registered silver, the silver that's actually available for delivery, has been declining while open interest, the number of outstanding contracts, has been climbing. Do the math on that. More claims on less metal. It's like a bank that's issued more withdrawal slips than it has cash in the vault. Everything works fine until people start asking for their money. And they are starting to ask. Large institutional players have been quietly draining physical silver from the COMEX warehouses. We're seeing delivery requests that would have been considered unusual just a few years ago. Why? Because sophisticated investors understand something that most people don't. In a world where central banks are printing currency at unprecedented rates, where geopolitical tensions are fracturing the global financial system, where trust in institutions is eroding, physical assets become the ultimate form of insurance. Let me take you back to a moment in history that rhymes with what we're seeing today. In 1980, silver hit its inflation-adjusted peak. The Hunt brothers, trying to corner the silver market, drove prices to levels that seemed insane at the time. But here's what most people forget about that episode. The Hunt brothers didn't create the bull market. They accelerated it. The underlying fundamentals, high inflation, currency debasement, geopolitical instability, those were already in place. The hunts just exposed how fragile the paper-silver market really was. When the squeeze happened, silver went from single digits to nearly $50 in a matter of months. Not because of manipulation alone, but because the physical market couldn't meet the demand when people wanted actual metal instead of paper promises. And when the bubble burst, it wasn't because silver became worthless. It was because the rules got changed mid-game. Margin requirements were raised. Trading restrictions were imposed. The game was rigged to protect the institutions that were on the wrong side of the trade. Fast forward to today, and we're seeing similar dynamics, but with one crucial difference. This time, it's not a couple of billionaire brothers trying to corner the market. It's the entire industrial complex of the modern world competing for a finite resource. You can change margin requirements, you can impose trading restrictions, but you can't print silver, you can't create it out of thin air, and you can't substitute it in the applications that are driving the green energy revolution and the digital transformation of our economy. Think about what's required to meet global climate goals. Solar panels are one of the most silver-intensive technologies ever created. Each panel contains about 20 grams of silver. Doesn't sound like much until you multiply it by the billions of panels needed to transition away from fossil fuels. We're talking about hundreds of millions of ounces of silver demand just from solar installations alone. And that's before you factor in the silver needed for electric vehicle charging infrastructure, for grid modernization, for energy storage systems. The International Energy Agency has projected that silver demand from the solar industry alone could more than double in the coming years. And here's the kicker. That projection assumes that solar panel manufacturers can actually get the silver they need. What happens if they can't? What happens when solar companies are competing with electronics manufacturers, with medical device companies, with defense contractors, all bidding for the same limited supply of physical metal? You get a price spike that makes previous rallies look like minor corrections. Because unlike investment demand, which can ebb and flow based on sentiment, industrial demand is sticky. Once a factory is built, once a production line is established, once contracts are signed, that demand doesn't just disappear because the price went up. Companies will pay what they have to pay to keep their operations running. Now let's talk about what central banks are doing, because this is where the story gets really fascinating. While central banks have been accumulating gold at record levels, something else has been happening in the silver market that's flying completely under the radar. Sovereign wealth funds and central banks in certain countries have been quietly building silver positions, not through public announcements, not through official reserve reporting, but through strategic purchases in the physical market that are showing up in import and export data. Why would they do this? Because silver is gold's volatile little brother. It moves faster, it moves harder, and when the monetary system is under stress, it can deliver returns that make gold look conservative. Central bankers understand monetary history. They know that silver has been money for thousands of years. They know that in times of currency crisis, precious metals become the ultimate safe haven. And they know that silver, with its dual role as both an industrial metal and a monetary metal, offers a unique asymmetric opportunity. Here's something that should make you sit up and pay attention. The gold to silver ratio, the number of ounces of silver it takes to buy 1 ounce of gold, has been historically out of whack. For most of human history, that ratio has averaged somewhere between 15 to 1 and 30 to 1. There have been periods where it's gone higher, but those periods have always corrected, often violently. Recently, we've seen the ratio compress from extreme levels, but it's still well above historical norms. What does that tell you? It tells you that silver is still undervalued relative to gold, even after its recent rally. When that ratio normalizes, and history suggests it will, the move in silver will be breathtaking. We're not talking about a 10 or 20% gain. We're talking about the kind of move that creates generational wealth for those positioned ahead of it. Because when silver starts to catch up to gold, when industrial demand collides with investment demand, when the paper market finally breaks under the weight of delivery requests it can't fulfill, the price discovery process is going to be unlike anything we've seen in modern markets. Let me share something with you that most financial advisors won't tell you, because frankly, most of them don't understand the precious metals market well enough to give you proper guidance. The traditional 60-40 portfolio, 60% stocks, 40% bonds, that model was built for a different era. It was built for a time when central banks weren't monetizing debt at unprecedented levels. It was built for a time when geopolitical stability was the norm, not the exception. It was built for a time when the dollar's reserve currency status was unquestioned. We're not in that world anymore. The BRICS nations are actively working to create alternative payment systems that bypass the dollar. Trade settlements in local currencies are increasing. Central banks are diversifying away from dollar reserves. The very foundation of the post-World War II monetary system is being challenged in ways that would have seemed unthinkable a decade ago. And in that environment, having a portion of your wealth in hard assets, in things that can't be printed, that can't be debased, that have intrinsic value, that's not speculation, that's prudent risk management. Now, if you're sitting on retirement accounts worth over $100,000, this next part is specifically for you. There's a strategy that allows you to get physical precious metals into your retirement account without triggering tax penalties. It's called a gold IRA, and it's one of the most powerful wealth protection tools available to American retirees right now. I've put together a comprehensive guide that walks you through exactly how it works, what the rules are, and how to avoid the common mistakes people make when setting these up. You'll find it in the description. It covers everything from the IRS regulations to choosing the right custodian to understanding storage requirements. If you're concerned about market volatility, about currency debasement, about the long-term stability of paper assets, this is worth your time to review. Let's get back to the supply-demand fundamentals, because this is where the story becomes truly compelling. The silver market is relatively small compared to other commodity markets. The entire annual mine production of silver is worth less than what some individual tech companies spend on stock buybacks in a single quarter. That small market size creates enormous leverage. When new money flows into silver, when investment demand picks up, when industrial users start stockpiling because they're worried about future availability, the price impact is magnified in ways that don't happen in larger, more liquid markets. And here's what's keeping mining executives up at night. The lead time to bring a new silver mine into production is measured in years, not months. You can't just flip a switch and increase supply. You need to find the deposit, which is getting harder. You need to get permits, which is getting more difficult in many jurisdictions. You need to raise capital, which requires convincing investors that the project will be profitable at future silver prices. You need to build infrastructure, hire workers, establish supply chains. By the time a new mine is producing, the market conditions that justified the investment may have completely changed. But demand? Demand can shift in a matter of months. A new government policy promoting solar energy, a breakthrough in battery technology that requires more silver, a geopolitical crisis that drives investors into safe haven assets. These things don't wait for mine production to catch up. They happen in real time, and the market has to adjust through the only mechanism available: price. Let me tell you about something that happened recently that didn't get nearly enough attention. Several major silver ETFs reported significant inflows, meaning investors were buying shares, and the funds had to purchase physical silver to back those shares. At the same time, industrial users were increasing their purchases to build inventory buffers, and sovereign buyers were active in the market. All of this happening simultaneously. The result? Prices moved sharply higher, but here's the interesting part. They didn't move as high as the fundamentals would suggest they should have. Why? Because the paper market absorbed a lot of that buying pressure through futures contracts and derivatives. But there's a limit to how long that can continue. Eventually, someone holding a paper contract is going to stand for delivery. They're going to say, I don't want to roll this contract forward. I don't want to settle in cash. I want the actual metal. And when enough people do that, when the physical market has to clear at prices that reflect true scarcity rather than paper promises, that's when you see the kind of price moves that rewrite the record books. History is littered with examples of markets where the paper price and the physical price diverged, and it never ends well for those holding paper. The London gold pool in the 1960s tried to suppress gold prices through coordinated central bank selling. It failed spectacularly. The Hunt silver squeeze exposed the fragility of the paper silver market. The 2008 financial crisis revealed that many safe paper assets were anything but. The pattern repeats because human nature doesn't change. People want to believe that paper promises are as good as the real thing, right up until the moment they discover they're not. Now let's talk about what this means for you, for your family, for your financial future. We're living through a period of unprecedented monetary experimentation. Central banks have expanded their balance sheets to levels that would have been considered reckless just a generation ago. Government debt has reached levels that, historically, have always led to either default or debasement. The purchasing power of fiat currencies is being eroded by inflation that's proving far more persistent than policymakers expected. In that environment, owning assets that have intrinsic value, that can't be printed, that have thousands of years of history as stores of wealth, that's not a fringe position. That's common sense. And silver, with its unique combination of monetary properties and industrial demand, offers something that few other assets can match. It's a hedge against currency debasement. It's a play on the technological transformation of the global economy. It's a speculation on supply-demand imbalances that are becoming more acute with each passing year. Think about the retiree who watched their purchasing power erode over the past few years as inflation ate away at their fixed income. Think about the investor who's nervous about stock market valuations that seem disconnected from underlying economic fundamentals. Think about the person who understands that the financial system is more fragile than the headlines suggest, who wants to own something real, something tangible, something that will still have value regardless of what happens to banks, to currencies, to governments. Silver speaks to all of those concerns. It's affordable enough that regular people can accumulate meaningful positions. It's liquid enough that you can sell it when you need to. It's recognized globally as a store of value. And right now, it's setting up for a move that could be truly historic. Let me share one more piece of the puzzle that ties everything together. The derivatives market for silver is enormous relative to the physical market. Banks and financial institutions have sold massive amounts of paper silver through futures contracts, options, and other derivatives. They've done this for various reasons: hedging, speculation, market making. But the net result is that there are far more claims on silver than there is actual silver available to deliver. What happens when the music stops? What happens when contract holders decide they want physical delivery instead of cash settlement? What happens when industrial users, worried about future availability, start building strategic reserves? What happens when investment demand surges because people finally wake up to the supply-demand imbalance? You get a short squeeze of epic proportions. You get a scramble for physical metal that overwhelms the available supply. You get prices that gap higher because there aren't enough sellers at any reasonable price. You get the kind of volatility that creates fortunes for those positioned correctly and devastates those caught on the wrong side. And here's the thing. You don't need to predict the exact timing. You don't need to know whether this happens in 6 months or 18 months or 3 years. You just need to understand that the fundamentals are in place. The supply deficit is real. The industrial demand is growing. The paper market is over-leveraged. The geopolitical environment is unstable. The monetary system is under stress. All of the ingredients are there. The only question is what catalyst finally lights the fuse. It could be a major industrial user announcing they can't source enough silver to meet production targets. It could be a sovereign wealth fund making a large physical purchase that drains available inventory. It could be a derivatives blow-up at a major bank that exposes the fragility of the paper market. It could be a shift in monetary policy that drives investors into hard assets. It could be any number of things, or it could be a combination of factors that all hit at once. But when it happens, when silver finally does the unthinkable and breaks out to new all-time highs, when it starts moving in a way that captures mainstream attention, when CNBC is running breathless coverage of the silver surge, it will be too late to position yourself advantageously. The best prices will be gone. The premiums on physical metal will be through the roof. The opportunity to get in ahead of the crowd will have passed. That's why smart money is accumulating now. While prices are still reasonable, while physical metal is still available at modest premiums, while the crowd is still distracted by other things. They understand that in markets, you make your money by being early, by seeing what others don't see, by having the courage to act on your convictions before the trend becomes obvious to everyone. Think about every major bull market in history. The people who made life-changing returns weren't the ones who bought at the top when everyone was talking about it. They were the ones who bought early, who endured the skepticism, who held through the volatility, who understood the fundamentals well enough to ignore the noise. They were the ones who recognized that sometimes the market misprices assets so badly that the opportunity is simply too good to pass up. Silver right now is one of those opportunities. Not because I say so, not because of hype or promotion, but because the mathematics of supply and demand are undeniable, because the structural deficit is real, because industrial demand is growing faster than mine production, because the paper market is over-leveraged, because the monetary environment favors hard assets, because history shows us that these imbalances always correct, and when they do, the moves are spectacular. So what should you do with this information? That's ultimately your decision. But I'll tell you what informed investors are doing. They're allocating a portion of their portfolio to physical silver, not their entire net worth, not money they need for living expenses, but a meaningful allocation that could make a significant difference if silver does what the fundamentals suggest it should do. They're buying physical coins and bars that they can hold in their possession or store in secure facilities. They're looking at silver IRAs to get precious metals into their retirement accounts. They're treating this as insurance that could also deliver spectacular returns. And they're doing it now, while the opportunity is still available, while prices haven't yet reflected the reality of the supply-demand situation, while the crowd is still asleep, because they understand that in investing, timing isn't about being perfect. It's about being early enough that you can build a position before the obvious becomes obvious to everyone else. Before we wrap up, I want to make sure you have access to all the resources that can help you navigate this opportunity. Remember that free guide I mentioned earlier? It's in the description below, and it contains information that could be crucial for protecting your wealth in the years ahead. But here's something extra for those of you who've watched this far. If you're an American retiree with at least $100,000 in any retirement account, you qualify for a complimentary one-on-one educational web conference. No obligation, no pressure, just a detailed walkthrough of how to position your retirement savings to weather the storms ahead. Mention that you watch this video and you'll get priority scheduling. This is only available to qualified individuals and spots are limited, so if this applies to you, don't wait. The silver market is at an inflection point. The fundamentals have never been more compelling. The supply deficit is accelerating. Industrial demand is soaring. The paper market is stretched thin. The monetary environment is deteriorating. The geopolitical landscape is fracturing. All of the pieces are in place for something truly extraordinary to happen. The only question is whether you'll be positioned to benefit from it when it does. The information is out there. The opportunity is real. What you do with it is up to you.